one of my favorite topics to train on from stage all over the place every time that I've ever been anywhere at any training in the United States, whether it was for Owens Corning or Beacon or Lennox or the Home Depot programs, was introducing the concept and idea behind the different types of buyers that you will encounter at the point of sale. And it's really for anything when you think about automobiles and just the way people, the psychology of the way people purchase. That's what we're going to kind of dig into here today to break down some of the differences between a cash buyer and some of the differences between a payment buyer. Now, what I've seen in the years as I've been watching lender programs grow and get more unique is the fact that these lender programs are now, they're getting pretty savvy. Even some of the hybrid loan programs out there to satisfy the needs of both of these folks have kind of crept into the place over the last 5 years. So talk a little bit about that today, how a hybrid program, kind of like a combination of a promotional loan that rolls into a low monthly payment fixed option with no prepayment penalty at the end, can work for some of your companies, some of your customers if you ever have any real strict objections, right? So cool. So let's break this training down. It's pretty simple. It's pretty straightforward. Why is this important? As a home improvement contractor, understanding the nuances between these two people are super, super important at the point of sale. Now, in some of my other trainings here, I've talked about the different types of buyers. So you've got the cash buyer and you got the payment buyer. But we also have the three different buckets, the psychology of the buckets of the customer's need. So in home improvements, you're going to have the grudge purchase, and that would be like a roof, a leaking roof, or a hole in the roof that has to be replaced or repaired. Air conditioner that just finally, after all the year, blows up, right? It dies. That's a grudge purchase. They have to do it. And then you've got the next bucket, which is in the middle, which is the need want. And some of the need want stuff could be like, I need a new kitchen. I want a new bathroom. I need new appliances, right? That's your need want. And then you've got the ego. Now, the need want and the ego kind of blend together. So let me talk about the ego purchase. That would be something like big, beautiful outdoor living patio area with the double burners and the black stone Japanese cooktop with the waterfall that rolls into the pool, right? Like, come on. You don't need or want that, but it's an ego thing. You're like, we're going to have this, we've got the money, blah, blah, blah. Those are kind of the type of psychological things that you'll run into in home improvement sales. So what's really cool is after you've done this for a while and you've really gotten, tuned in to how to offer financing at the point of sale, you'll see grudge purchase, need, want, and ego, and you'll be able to identify this. And then once you've identified who your cash buyers and your payment buyers to line up the proper solutions to it, speak to it, that's when you're going to get really, really, really great at this. And then you've got the short, mid, and long term, and then you'll be able to better tailor the approach and personalize the finance solutions to your particular prospective customers and your homeowners. Because remember now, at Improvify, you're going to have both. You've got unsecured lending at the point of sale from $2,000 to $150,000, and you also have secured lending from $15,000 to $400,000 at the point of sale. So we got to kind of balance out what the solution is back to that particular buyer and then the scenario that they're in. So it's a competitive market. The more you know about the psychology of whom you're selling to, the better for you. So there's a lot of stuff here. Let's break this down. Let me get my big fat head out of the way so I can read this with you. So how can you better provide more value to your customers? Well, it starts by, of course, offering financing each and every single time. And in my trainings, repetitive. Always, early, and often. You should be offering financing always, early, and often in everything you do. From your advertising to your marketing, from the conversations and the demo and the inspection and your needs analysis to the laminate that you're leaving on the table that introduces your consumer centers, your company's consumer financing center. And it's set at an angle. And it talks about the promo and the short term and the long term and the soft credit pull. Financing provided by or powered by your logo. Your customers need to see the laminate because you're introducing it to them. So your goal is to elevate their original vision and show them how great their home will be or could be, whatever that particular home improvement project is. So if it is an air conditioner, the goal of that air conditioner is to keep the house cool. Or maybe if you're up north, keep the house warm in the winter. The goal of the roof is to make sure that they don't have a hole ruining the rest of their property, or even the fact that some of these insurance companies now are actually forcing them to replace a perfectly fine roof. Like, insurance policies are really making a big impact now. So you want to be sure of what the actual home improvement is going to do to satisfy the lifestyle needs and what it will be. And that's what you want to lean on. So there's two types of home improvement buyers that there's probably more than two. But for the sake of this training, let's just act like there's two. You're going to have cash buyers. Now let's talk about what a cash buyer is. These customers typically have higher credit scores and they have the money in the bank, and they sometimes love to leverage OPM, other people's money, to buy the things that they want and need in life. And I'm talking in life in general. It could be they're down at the Mayor's jewelry store to buy a Rolex for their wife at Christmas. They have the $8,000 in their bank account, but they're not going to use that. They're going to use Mayor's deferred interest for 18 months. Or they're going to go to Ashley Furniture. They've got the money for the furniture, but they're going to use Ashley Furniture's 5 to 6 year zero interest. That's what we call promotional financing. Your customers that are cash buyers typically will lean in on leveraging money, OPM, other people's money. They're going to leverage it from a lender and not pay interest if paid within that promotional period of time. Now, there's different types of promotional loans. There's the ZIL, that's the zero interest loan. There's the SAC, SAC, that's the same as cash. There's deferred interest. There's with payment deferred interest. There's equal pay, no interest. There's NINP, NINP, no interest, no payment. Like, that's a lot of promotional loans. So it is imperative that you understand the difference between a WPDI, EPNI, NINP. That's why we're here. That's what we're talking about in all these trainings. Go to the definition section if you need to learn what those terms and loans are. More importantly, with your lender, ask them what promotional loans they have. Ask them what the rules are, meaning if my customer pays within the 12 months, did they suffer an interest rate charge, or is it accumulated to roll over at default? Default is if you do a 12-month same as cash and you don't pay it off within 12 months. What happens on month 13? What does it roll over to? What's the interest rate? For how long? What is the term? It is imperative that you know this stuff. Why? Because you need to educate your customers about what's going to happen if that cash buyer, that promotional buyer, does not pay the loan off on month 12 within that period of time. Why? Here's why. Because if you don't protect your company, you could be getting a 1-star review because you're the one that gave them that loan product. You want to educate them on, hey, I understand, Mr. Smith, that you have an 850 FICO. I understand that you don't want to pay interest. I understand that you want the 12 months the same as cash. But can you pay this $25,000 home improvement project off in 12 months? Because here's what's going to happen on month 13. Educate them. Tell them what's going to happen. That way, you're going to reduce the possibility of the customer being upset at you for putting him into the wrong loan program. And he who educates dominates. So if you've educated them and had a conversation with them about this, it will lessen the surprise if you didn't have the conversation. That's why we're here. That's why this training is so important. Your competitors are probably not getting this training. You need to know the difference. So reach out to your lender and ask them these questions. Who, if you enrolled with us, or maybe you're not with Improvify or our portfolio lenders, ask whoever your lender is now about the promos and what happens at default. Learn that, word track, and include that in your sales pitch, okay? They love them. They love leaning in on these. However, if you have that conversation, you're preparing them for what might happen down the road in the case of default. They'll thank you. And you can have a real empathetic sales consultative approach to this. Hey, Mr. Smith, we've got promotional loans. Let me explain. I'll explain how they work. And we've got short-term, mid